I didn't want to just be an investor. Like I really enjoy building business. I really enjoy coming up with an idea and having to figure out how to bring that to reality. I like that part. But what I liked about Saint Archer was having to go out and raise money. Like I like that we had a business plan and a concept that we couldn't afford ourselves. And we had to go out and pitch people, bring them in, and then manage the money responsibly. And then we got to see it full circle. And I'll tell you, there's nothing better than putting dollars in somebody's hands. It's the greatest feeling.
At this point, at what point did you, where did real estate investing come into the picture?
Yeah, so real estate investing came into the picture when I was younger. My mentor that my mom connected me with, my parents.
That was the financial advisor?
He had a brother who ran a storage portfolio. And that was my introduction into investing passively into commercial real estate. And there was something about real estate that felt very comfortable. And I always had confidence that it was going to be there. And then when I started investing in it passively, I started getting, in that offering, the cash flow is paid out quarterly, right? So I kept getting these quarterly checks. And after the third, fourth one, you're like, yo, this is it. I can count on this. I'm here for it. And so that, I was doing that for a pretty good amount of my career. So when we sold Saint Archer, I was trying to figure out what else to do. One, I didn't want to just be an investor. I really enjoy building business. I really enjoy coming up with an idea and having to figure out how to bring that to reality. I like that part. But what I liked about Saint Archer was having to go out and raise money. I like that we had a business plan and a concept that we couldn't afford ourselves. And we had to go out and pitch people, bring them in, and then manage the money responsibly. And then we got to see it full circle. And I'll tell you, there's nothing better than putting dollars in somebody's hands. It's the greatest feeling. And so I really wanted to kind of blend both of those worlds together. And then that mixed with, I really wanted to create an opportunity for athletes. That was one thing that I was blessed by. I was given knowledge, kind of empowerment and opportunity. So I wanted my company to have an opportunity that people could invest in, that they could count on being there. And then I wanted there to be an educational part to it. It's why we put so much content on social about financial literacy and education. And real estate was that asset class that I felt accomplished the goal for an athlete, which is we need to build our wealth because we're young, but we love cash flow. Cash flow is how we take control away from our employer, right?
Mm-hmm.
And it accomplished all the goals.
I love that. And so you knew real estate was the answer. And then how did it evolve from there? Because now you're doing self-storage deals, you're doing ground-up development, multifamily deals. But what was kind of the catalyst of to get you to where you are now?
Okay, so basically when I was skating, I was investing in storage passively, and I was investing in a debt fund as well. So I was lending on commercial real estate. When I came up with the idea for Commune, at this point I knew how to build business, and I knew how to raise money. So I'm working on my business plan. And I don't know why I thought this at this time, but I wanted to do a fund instead of a syndication.
Mm-hmm.
Knowing what I know now, I should have done a syndication. But anyway, I want to do a fund, and I wanted it to be in multifamily. I had no exposure to multifamily back then, and I thought multifamily fit my skill set better than storage. I'll explain why in a second. And so I brought my business plan to my financial advisor, and I had this page that was basically fund management, and there was a question mark. I didn't know what that meant. And so I asked him, I'm like, what am I missing here? Can you help educate me on this? Or who are the people that I need to bring in to help build this out? And he called his brother, Jerry, you gotta come in here. We gotta look at this. And what we ended up doing is we started a business together. And with the storage portfolio that I was investing in, how it works is you have a management company, and that management company manages the fund. But the company doesn't own the fund. The investors own the fund, right? So they had their management company. They had their fund that I was investing in. We created a new management company together, and then a new fund that was focused on multifamily, right? That's what Commune was. And then about 3.5 years into it, we were seeing such crazy growth because of the brand element and social and a lot of the stuff that we did with Saint Archer, we were doing with Commune. And my partners who ran the other management company as well, basically threw out the idea about us merging our companies together. And that ended up leading to us doing it down the road. It was about 2.5 years ago we merged. And so both management companies became one. It became Commune. And then the debt fund that I was investing in, the storage portfolio, and then the multifamily portfolio that we started all became Commune. And then from that point, we've created 2 additional funds and then a handful of syndications along the way.
Now, you guys are or you're not owner operators?
Some stuff we are, some stuff we aren't.
Okay.
What we try to do, and this is by and large our structure, our strategy. We like partnering with developers. So we have a handful of developing partners that we do most of our deals with, and so that puts us in a position of being able to do it at scale. If we were a private equity firm and a development and the management company, we're not there. So that's how we like structuring it. What that means for our company, we come on as the sole investor, we come on as the equity, and then we have certain controls that we have to have. We have to have full control to take over a project if something goes wrong. Now, we do have the ability to develop ourselves, and we have done that in the past. And there are a handful of projects that we self-manage, but by and large, we have third-party management, and we like to partner with developers.
And so with that, if you were to develop it yourself, and you mentioned that you guys could, what does that entail? That means that you guys are the ones that are managing this whole development project. You guys are the ones making sure the permits get done. You guys are managing the contractors, basically the A to Z, the budgeting, all that.
Yeah.
But if you guys source that out and partner with a developer, you guys are just placing the equity. Is that right?
Yeah, so this will make more sense as I explain the partnership. One of my partners is our head of development, and he is a developer. Like that, his background was development. He built one of our storage portfolios. Or one of our storage units, the largest one we own. And what we started doing is we put him in a position of overseeing the developing partners. So he's kind of he would be like, the developing partner would be the entrepreneur and we'd be the VC, and, he would be the ones overseeing the entrepreneurs, right? That has allowed us to do it at scale, but we have a project right now where we added about 350 units onto our existing, I think we had like 1,400 total. He oversaw that project. So he goes through the permits. He acts as the GC. He does it soup to nuts. Is that the phrase, soup to nuts?
Mm-hmm.
We just don't try to do it a lot like that.
Yeah, that makes sense. And so, yeah, it's an interesting business model, man. And I like how you partnered with your guy, brought it all in. Now, self-storage is a lot different than this development multifamily stuff. However, you guys are repurposing old retail facilities and then converting them over to self-storage. Is that the model there?
Correct. Yeah, big box retail.
And which is it? I'm curious. Is it same? Do you guys co-mingle the funds amongst these different projects and these different asset classes, or is it two separate funds and two separate investors for each one?
Yeah, really good question. So our storage portfolio is or our fund is the storage fund. The only thing in there is storage. And then in our multifamily, it's only multifamily. And then we have 2 multifamily funds. So what we do is we go after basically big box retail, Kmart's, Walmart's, Bed Bath & Beyond's that go vacant, become distressed. And when it all works out, which is difficult to do so, we basically scrape the inside and fill it with, anywhere between 1,000 and 1,300 units. For our portfolio, we have one developing partner that we primarily work with. And then we have other projects that we've done on our own. But the repurposing we like doing we do like doing that with partners. It's a lot of brain damage to get those projects through. The cities don't like them. Mm-hmm. And so very similar structure, I guess, with all that said.
With those projects, I'm curious, are you bringing the investors in right away? Or are you bringing them in on the back end when you kind of have a little bit more due diligence done?
Yeah, that's a really good question. So your podcast is primarily real estate listeners, right? So we don't like bringing our investors in pre-entitlement. It's a risk that we just don't want them to take. So we usually bring them in once it's entitled, or we are right about to be entitled and we feel highly, highly confident that we're going to get there. That's usually when we bring them in. What we like about that is that's our, some people that buy like existing product, they'll say, you make money when you buy, not when you sell. And you should buy with existing equity, meaning, if you're going to buy an apartment for $1 million and you're able to negotiate the price down to 900, well, you just bought it with $100,000 of equity right off the jump, right?
Sure.
We kind of like using that analogy in development where we think we're doing all of this value and we think there's value on the paper by, getting it entitled and ready to build. And so we like the idea of bringing them in. It's just one of our kind of value add to the investor, I guess you could say.
Yeah, that makes sense. So are you guys closing on these retail centers that are, let's say it's a Kmart, for example, in whatever city? Are you guys closing and acquiring this piece of land or this property with your own funds, and then you're bringing the investors in when you got the entitlement and all that ready to go?
Typically what we do.
Okay.
Yeah.
What's the biggest risk with these projects?
With all of them or in storage?
The self-storage.
Okay, so if the project is entitled, right? Let's say the city will allow you to do it and you start building. You have to be really careful that you're not building in an area that's saturated. Storage, it's pretty saturated right now. So you run the risk that you're not going to be able to lease it up at the rents that you thought. This is the easiest way to say it. There's a lot of there's crossover between multifamily and storage, right? Like when you're looking at a multifamily project, what you're really looking at it is, does this project have demand over the next 10 years, right? Can I get the rents I want to get, and will there be demand for the next 10 years? If the answer is yes, then, considering you gave yourself options, you're going to be pretty good.
Mm-hmm.
Storage is similar to that, but the challenge is if you're doing a value add play or a repurpose play, what you're usually doing is short-term debt or bridge debt until it's stabilized, then moving into permanent financing, right?
Mm-hmm.
The bridge debt market is built more for multifamily. There's not a lot of product that really fits storage. And the reason why I say that, it takes longer to stabilize. So what you end up seeing a lot of storage operators do is they go like bridge loan, then to permanent. If you're in a moment like this would be a good way to highlight, what the risk is. If you started building something, I don't know, 2 years ago, 3 years ago, and you're in lease-up process and you underwrote it for a certain interest rate, maybe a certain debt yield, or all of the metrics that would help you qualify for your permanent financing, you might not qualify now. And so there's a real risk that you may need liquidity at a time that might be challenging to get it.
Yeah, I can imagine with these retail spots you're repurposing to self-storage, there's a period of time from a lender's perspective to where this property is not worth a lot of money.
Right.
But on the flip side, like a multifamily deal that you're doing some value add or renovation package, there's still tenants living in the property. And from a risk standpoint, that property still has a lot of value. So it makes sense. And I kind of see that.
And then I would say there is risk on the entitlement. Like, it is very difficult to get these things entitled. Like most cities, we talked about this earlier, most cities do not like storage. And then also they don't want storage in what used to be a retail center in a prime location of the community. They want to put storage on the outskirts. And so, when you lock a project up under contract, it takes a lot of time. It takes money to, in a lot of cases, know that you're not going to get it through. So that is a potential risk.
What's the exit strategy then if you guys acquire the property with your own money, you realize, hey, we can't convert it? What's the exit strategy?
We won't acquire it. We'll put it under contract, and then it'll be contingent on that.
So you guys have certain, okay, got it. That's in the LOI, or when you put it under contract, that's in the agreement.
Yeah.
These are the terms.
We
have to have the entitlement before we close.
Correct. We will not close if we can't get it entitled.
So these are long contracts.
Oh yeah.
How long is the longest one you've seen?
We've worked on projects where we're trying to get the deal through for year, 2 years. It dies, comes back to life 2 years later, takes another year of us working. I mean, things die over and over and come back.
Yeah.
That's part of the process here.
When you get a no, is it typically a hard no, or is it like, okay, there's a way to figure out how to turn the no to a yes? You just got to get more creative.
Well, look, being on city council now, like this is actually, it's interesting because I'm experiencing on the other end.
Mm-hmm.
Every 2 years, you have people that have potential to move positions, right? And you might have a scenario with a city where you have 3 of the 5 council members that are maybe more pro-growth, and then in a different cycle, it might be flipped. And so there's an argument to be said that you wait council members out. The other part is, it's understandable, right? If you had a Kmart, and a Kmart created jobs and creates revenue for the city, everything, right? If it's vacant, and let's say it's vacant for a year, you're still kind of hoping that it can become something else, not storage. Well, the longer it sits vacant, And the more you start seeing things like, weeds growing up, out of the cement, or windows being broken and they're not getting fixed, that's a pretty scary place for a city to be. And so, if it's still sitting there, that puts more pressure on a city to go, we have to figure this out. And so that sometimes is a big factor.
Yeah, that makes a lot of sense. And I can see why these cities don't necessarily want the self-storage, especially in the more congested parts of town where there's a lot of drive-by traffic, because, I mean, let's be honest, the self-storage is not the most aesthetically pleasing property. And similar to mobile home parks, probably not quite the same stigma. And you mentioned before we started recording that, these self-storage facilities also, they're not creating a ton of jobs. You could have a huge facility and maybe only have 1 or 2 people on site.
Right. That's exactly right.
So I get that.
Multifamily is much easier to get through right now.
I can imagine.
There's so much demand that most council members now throughout, I mean, in our state for sure, but most of them are going, yes, 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 yes.
Yeah, it's and this is California too. I mean, bureaucracy here is definitely more challenging than a lot of other states.
Yeah, so our portfolio is hyper focused on California, the multifamily side. The storage side, we have one asset here, everything else is out of state. So our strategy is very difficult to be hyper focused on a market, but multifamily, it's a lot easier to do so. So that's why they're different in that strategy.
Are these different investors in both of your funds? Or are they typically investors that are kind of diversified across both assets?
They don't have to be. There's definitely some that are in all of our funds,
Mm-hmm.
and then there's some that resonate with the asset, not the return profile. Right? There's some people that look at me and go, I don't care for storage. I don't want it. Like, I understand it's a great return. I'm good though. And they'll go into multifamily, or let's just say multifamily, because they think it just feels cooler or seems cooler. Others that are looking at it through maybe a risk profile or what the purpose of the entity is,
Mm-hmm.
that might drive their decision. For example, our storage portfolio is closed right now, but when it's open, an investor comes in and gets to participate in cash flow right away, and then they get to participate in growth. So you get kind of a hybrid between growth and cash flow. Our multifamily portfolio, it's all growth. So for new investors that come in, they're saying no to cash flow now to potentially get a bigger return or build it to the desired cap rate in the future. And so that will put some people in here and not the other. And then in the debt portfolio, somebody who just wants income and wants to remove the equity risk, maybe that's a better fit for them. So it's a little bit all over the board.
Yeah. You mentioned that when you got into the commercial real estate, you first started the fund, and had you done it again, you would have maybe just started with a single asset syndication. Why do you say that?
There's pros and cons to both, but funds are a lot harder to raise money for. In our experience, it's more difficult. If you're raising for a syndication, it's much more simple for an investor to understand. This is the one project. This is the targeted return. This is the targeted timeline when you're going to start seeing cash flow. This is the time we're going to try to exit. It's just a clear shot for them. Also, when you close, you're closed. You don't get another shot, right? So there's an element of FOMO for whatever reason where people are like, if I don't get into this one, I lose this opportunity.
Mm-hmm.
Where when you go into a fund, you don't have that urgency at every time to go, if you miss this deal, you're out. It's, okay, so you're going to close on this one, but you're still going to raise for these 3, and yeah, I'll just wait till the next one, right?
Yeah.
And then also, it's a little bit more complicated for an investor to understand because you're now looking at multiple deals, and if you're in development, the cash flow is spread out, and usually you're not going to distribute cash flow when the first one is cash flowing, or you're not going to distribute a dividend when the first one cash flows because you want to use that cash flow into the next deal so it's less dilutive, right? And then it makes it way more difficult to show an investor, this is when you see money. But there's a lot of pros to the fund. I mean, from an operational standpoint, that is way easier in my perspective. You get diversification. If you build it to a certain point, all of a sudden, like a line of credit comes into play. And that was huge for us with our storage portfolio. Having a line of credit allows you to be very, very quick on acquisitions.
When you say a line of credit when you establish your fund, what do you mean exactly? Learning to become a successful real estate investor can take a lot of time and dedication, which some people just don't have. If you're one of these individuals, this doesn't mean you can't invest in real estate. My company, Summers Capital, is buying a bunch of boutique hotels right now, and you can invest with us in these deals without having to do any of the work. Our team sources the deals, we secure the lending, we take care of all the renovations, and we even handle all the day-to-day operations with our in-house management company, making it truly hands-off and passive for our investors. If you want to learn more to see if we can help you, go to summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show.
Yeah, so basically a bank is not typically going to give you a line of credit on a syndication, but when you have a portfolio of assets that are stabilized, you get to a point where a bank will start giving you a line of credit that's, collateralized by your assets, and you can draw from that. You don't have to raise money. So if you have a $10 million line, think about, when you're having to close on an acquisition, you don't necessarily have to go through the challenge of raising capital in the time frame to close. You use that, then you can backfill the investor to follow,
So you could, let's just say you got a fund with 4 assets within it. They're all stabilized. Each of the 4 assets has its own mortgage in first position. You're saying as long as you got enough equity amongst the 4 assets and they're stabilized, a bank will come to you and say, hey, we'll give you a line of credit for a portion of that equity that you have.
Correct.
Dude, that's awesome.
That part is phenomenal. You
I didn't know
can't
that.
do that on syndications.
Mm-hmm.
And it took us a long time to get there. But if you're willing to go through the challenge of raising capital for a fund, that is a huge advantage. It's a huge advantage for your investors.
Yeah, that's something I didn't even realize. We just launched our first fund and in the middle of the raise right now. But yeah, that is a very, very intriguing thing I didn't even think about. The other thing is, from a diversification standpoint, it's like if one of the 4 deals, falls a little bit short from an assumption standpoint, and the other 3 deals are good, well, now the blended return is still in the green.
You just reminded me of why I wanted to start a fund and not a syndication. So I wanted to use social media to build this portfolio, to build this brand. And in the beginning, I was like, shoot, what's it going to look like if I bring different investors into different, let's say, apartments, and one apartment doesn't perform at the same rate as the other? And will I run the risk of having some investors going, this is great, some investors going, this isn't what he says he is? And so I think in the beginning, I felt like it was easier to maybe have a consistent experience, but syndications are easy to raise capital for. They definitely are.
Yeah, definitely.
And we're out here launching funds.
Yeah, I can see that. Especially early on, it's like, well, okay, if you're with ours, that's 4 assets, and so if it's early on and you only have 1, maybe 2 identified, some of the investors that, especially newer investors, might say, hey, let me get in on another round when we have established financials for the first couple, and they can kind of have a clearer picture of what exactly is going to be in the fund. So I totally get that. But from an operations standpoint, it's so much simpler. I mean, 1 set of reporting,
Right.
1 set of investors, versus 4, or if you have 6 properties, that's 6 different set of investors,
That's
6
right.
different sets of reporting. That's a lot more workload,
That's right.
And so I can see the pros and cons. And for me, I figured, you know what? There's never going to be a perfect time to do it. And so I was like, let's do it.
Yeah,
Now's
that's
the
right.
time.
That's
Let's
right.
rock and roll. And
That's right.
we'll our investors are excited for it, but it's been fun. What is the biggest risk on the development side? You guys are doing the multifamily ground up. What's the biggest risk in those deals?
Oh, okay. So look, in this moment in time, I think the refi risk is the greatest risk for us right now.
Because of the rate environment?
Yeah. So basically, we're okay. We got the Fed trying to get a grasp on inflation, right? We talked about this today, and we think we know what the Fed's going to do. But if you listen to Jerome Powell talk about it, he alludes to a possibility of something, but he never commits to. The Fed is 90% talk, 10% action, right? And really what he's saying is we're going to look at this from a day-to-day basis and just look at the data.
Mm.
Because of that, we're in a scenario where we have a inverted cap rate, right? We have interest rates higher than the cap rates, especially in our market. And so you have to ask yourself, okay, is interest rates going to continue to go up? Will cap rates follow? They don't have to. In the 80s, they definitely didn't. And on top of that, what are the banks underwriting to today? And what are they going to underwrite to a year or 2 years from now? And how different is that than it was last year or the year before, right? So if you were underwriting, we talked about being conservative in our underwriting. If you were underwriting your project once it was stabilized and moving into your permanent financing off of, let's call it a 5 cap, or, the bank requiring a 7% debt yield, or a, certain debt service coverage ratio, whatever it is, it's not the same today. They're now requiring more. And so you run the risk of not qualifying for that permanent financing and having to put more equity in the deal, right? Having a liquidity crisis or liquidity squeeze. That is a challenge, right? If you take this moment out, like, what's the typical risk for building? You have your entitlement risk. You have the risk of you not expecting the unexpected to happen, right? So if you're expecting the project to take a year and a half to build, and you didn't prepare for the scenario where it could take 2 years or even longer than 2 years, if you're expecting to hit certain rents and, maybe you're not able to, you're hitting a 20% discount, if you, run over your budget by 20%, these are all factors that are risks that can put your asset, in a distressed scenario. If you prepare for it, okay, I think you put yourself in a position to succeed. But what we see a lot of investors do is everything has to go according to plan to succeed. And that is not a reality. That never happens. So I think that would be the risk.
But you guys are mitigating a lot of these risks. I'm sure you guys are underwriting to a more conservative exit cap rate and maybe a more conservative DSCR on the refi.
Right.
And then I'm sure you guys are raising additional funds for contingency capital. Should there be change orders, or should you go over budget, or even timeline?
Right.
And that's one way to mitigate it. Now it's gonna lower the return profile.
Correct.
The target return profile. And so that's another thing. It probably makes it a little bit more challenging to raise capital when your return profile is reduced by 3, 4, 5 basis points. But the investors that are savvy are they're gonna understand that, and they'll appreciate that.
Right.
And I think it makes it a little bit easier to under promise, over deliver, if you would, versus going the other route. Hey, we'll get the money in right away. However, everything has to be lined up for us to hit that projection.
Right. We are a conservative group. Like, we have investors that do not invest with us because they think we are too conservative, and that's what they should do. That's fair. But when we're underwriting a deal, and we talked about this earlier, which just sounds like there's a lot of similarities here. When you're building something, if it's going to take you 2 years to build it, let's say a year to stabilize, at year 4, like right after it stabilized, if you were to sell it, that's going to be your highest return because of the time, or the highest IRR because of the time, right?
Mm-hmm.
And so when we look at a deal, we typically look at it at a 5-year hold and see what the return looks like. But then we also stretch it out and actually underwrite it to a 10-year hold. And that's really what we're looking for is, what happens in a scenario where we can't sell it at year 5? And if we can't, is this an asset we want to hold for 10 years? And if we do hold it for 10 years, what's the return at that point? And so that's one thing that we, when we're talking to new investors, we're walking them through that timeline. Look, this is what we're hoping for, but if we can't do it, this is what we're prepared for, and this is the return in that case. And then even when we're looking at our modeling, we talked about some of the things that could go wrong. We project, certain scenarios in the future, and we rely heavily on CoStar and The Economist, et cetera. But even if they're saying, in this market, you can expect a 5%, rent increase per year, we're going to underwrite it to that. But then we're also going to look at a model where, what if there's no rent growth, right? If they're saying the, cap rate in year 5, they're projecting it to be, a 5 cap. Well, what does this thing look like at a 6, right? What happens when we talked about, timeline to build? If we're expecting to build it in 2 years, what happens if we hold it for 6 years? And when we're doing that, we're looking at all of the ways each component brings the return down. And then basically how we figure this out at the end is, what happens if we're in like a doomsday scenario? What if we're in Armageddon and we hit all of the levers, right? Everything goes wrong. What does this deal look like? And that return goes way down. Like, we ran this on a current deal. I think the return went down to like a 2% return. But
you're not losing money.
In a scenario where everyone else is losing money, we're okay with that.
Mm-hmm.
In an Armageddon scenario, we still make little money. We're okay with that.
And if you get into that scenario and you can hold the asset for another 3, 4, 5 years to where things will improve, and they will improve, then you're going to be good. And I love that you guys are, underwriting to a longer time horizon. It's like, hey, tell the investor, like, if we can get this 10-year projected return in year 5, we're going to look to do that.
Right.
However, if it's not an opportune time to exit in year 4, year 5, we're prepared to hold this asset, 10 years if we need to,
Yeah.
because we're protecting your capital.
That's right. And this just played out this way. We had 2 projects that we raised money for, I don't know, 4.5 years ago. And we pitched on that. We ended up selling them. We had a great experience. Everybody gets money, like everybody's happy. But if we weren't able to sell, we were fine. And then I think that the last thing I would add to it is we're really focusing on markets that are severely undersupplied, like severely. And really what we want to feel comfortable with is the demand side. We want there to be demand for the next 10 years, because if there's demand and you've underwrote it the right way and you've prepared for the unknown, so what? Like, participate in cash flow when cap rates soften. There's nothing that forces you to sell. There's nothing that forces you to sell. I am totally good with that.
Some of the markets I know on the multifamily side where there's a lot of demand, there's a lot of growth. Some of the hotter markets, let's say Phoenix right now, that's been a really hot market. A lot of markets in Texas, some of the markets in Florida come with a lot of new builds, right? But I noticed you guys are doing multifamily stuff here in California where there's a lot of bureaucracy. And so there's a higher barrier to entry to build.
That's right.
And so I love that play, because not only are you guys going into markets where there's, always going to be demand. People are always going to be wanting to live in California, especially people that make money. But on the flip side, you don't run the risk of oversupply because of all the bureaucracy and red tape that we have here.
That's right. Like, look, when we talk about investing in California, I hear it all on social media. People think we're crazy, and I get it, right? I totally get it. What you touched on is the normal cycle, right? You have a market that's hot and it's easy to build. The builders go there and build, right? Money typically flows where it's easily accessible, or the least amount of friction, right? But what happens because of that is they build too much. This is such a normal cycle. And then it oversupplies and the market corrects, right? What we like is actually what drives a lot of investors out of California, right? One of the perfect examples would be this new mansion tax in LA City.
Oh man, don't get me started with that.
But you know what? It's another example
Barrier.
to it, right? You're now adding a additional cost if you sell an asset, right? I think the breakdown is you sell an asset between 5 and 10 million, it's a 4% tax. If you sell it north of 10, it's a 5.5% tax, something like that,
exactly
right? But it applies to multifamily as well, right? Well, here's the reality. You just made the cost of doing business in California more expensive. There will be investors that will not build here now, right? For investors like us, we go, wait, so you're keeping our competition out in a market that's undersupplied? Like, okay. And then you add, the elements of how long it takes to get a project online. Like, one of the projects that we're building out right now, from the point of us first working on it till us actually stabilizing it, it's gonna be 6 years, right? It is just not easy to do so. And so we think there's a strong case to be made that because it is so difficult, it artificially drives prices up. And if you know how to build here, which it is hard, we've seen a very good return because of it.
I feel like a lot of the people that dog investing or buying in California, they've actually never owned real estate here,
Right.
Which is intriguing. But
And look, I will say this, like, I'm not mad at you. Like,
no, for sure, I get it.
You know what I'm
I
saying?
get it.
It is brutal, and it takes a lot of time. And in that time, if you don't know how to do it, you can lose money. But we've been doing it a long time, and I do like, at the end of the day, the idea that I don't think we're going to be able to hit demand. Like, we are so undersupplied. Just from if we were to go back when we started Saint Archer, and that was part of our pitch, like, hey, investors, look, there is so much demand that we will never be able to produce enough. Every single drop we make, no matter what, it's gone. In 2 seconds, it's gone. Everybody would be giving us, are you kidding me? That's like the ultimate sales pitch.
Right.
In California real estate, in a lot of the markets, you can kind of make that pitch.
Yeah, no, that makes sense, man. And I don't know, I just think, like, if you look at the real estate here, low cap rates, sales comps are very expensive. You guys are doing ground up development. And I always tell people, whether you're doing a heavy, lift or it's a ground up development, well, it's a lot of time and work that goes into these projects. And relatively speaking, it's the same time and cost to build in the middle of the country in Oklahoma than it is here in a hot market in California. But I know we're going to create a lot more equity growth,
Right.
and we're going to have a much larger delta to capture by doing it out here in a hot market in California. So I totally get
Yeah,
that.
that's right.
And kudos to you, man, for
Thank you.
the strategy there. I
Yeah, I
like it.
appreciate that.
I want to switch gears a little bit. With all this stuff right now, we get the recent bank collapses. We got this high, interest rate environment that we're in. There's a lot of bad news out there in the marketplace. Where do you kind of see things navigating over the short to midterm, the next 6 to 12 months? Hey guys, real quick, I hope that you're finding value in this show. If you could do me a huge favor and drop a 5-star review on Apple Podcasts or whichever platform you're listening on, it would mean the world to me. Also, if you know of anyone that would potentially benefit from this podcast, feel free to share it with them so we can help more people build wealth through real estate investing. Now back to the show.
That's a good one. I'm going to start by saying, who knows? Because we're in a different position where today than I thought we were going to be. Like a lot of the numbers that we just saw, we saw the unemployment, we saw the job numbers healthy, right? Which when you think of that through the lens of inflation, that's a bad sign for inflation. That means the demand is still high, right? When you look at wage growth, right? You now have wage growth below inflation, which I don't want this to sound as if it's a good thing, but just in the context to inflation, oh, okay, that would actually be a good sign that inflation is coming down. With all that said, my expectation, I think we're going into recession. I know, everyone talks about a soft landing or a scenario where we avoid it. I'm not sure how we do that. If the goal is get inflation down, what I'm kind of expecting the Fed to do, I think we're going to see another rate increase, and then I'm probably expecting a pause. It's so hard to say.
Mm-hmm.
It is so hard to say.
The bond market is pricing in, they were pricing in this most recent hike they did a week ago, but they're not pricing in a future one.
I know, but
so we'll see how it reacts.
That part's interesting to me, right? I was looking at this the other day. You have investors that are pretty much like, we're seeing a pause. You saw this increase of demand in mortgage, right? You're seeing the energy go, pause, right? So then the question becomes, okay, so if that is the experience, what's that going to do to demand? Is everybody now going to think like, dude, we're good, let's put more juice in it? And then is inflation going to run back up, right? And that's something you saw in the 80s. It's like they thought they had inflation, handled. They didn't. And then Volcker went scorched earth on them, right? So I don't know. Now, the hard part, and why I'm glad I have no involvement with the Fed, a lot of the things that we've seen them do over the last, how long have we been doing this tightening thing for? A year?
Yeah.
All of it hasn't totally come into effect, right? There's a lagging factor. And so if they keep going, there is the argument that they went too far and this thing, we get put into a deep recession, right? That's totally fair and at play. I don't know if we're going to know if the Fed is making the right decision without hindsight. I think that's the only way we're going to know this. But I do think we're going to get into a recession. I think, it's going to be uncomfortable for sure. I'm not expecting the real estate market to crash. Like you saw like Elon, we saw some people going, the commercial real estate market is in for a spanking, right? I don't think that. I think there's going to be an opportunity for, pref equity, or there's going to be recapitalization opportunity. I don't think we're going to see like blood in the streets. Office, maybe. Everything else, I don't see it.
Office was struggling a little bit before, all these rate hikes, and I get that. But, to your point, man, what you're buying and what we're buying right now in this climate, we're buying deals where we're adding a tremendous value.
Right.
And so you price in all that equity growth, the market can continue to soften, cap rates can continue to go up for the next couple of years. And then you factor in the fact, you have a 10-year time horizon. It adds a lot of safety there. But if you're buying turnkey product right now, and you're paying retail pricing and you don't have much value add potential in these deals to create that buffer, that's where I think you're going to see a little bit of trouble right now.
Yeah, I think you will, but maybe this is adding to it. Maybe this is pushing back. I'm not sure. But for us, like the smaller investors, 1,000%. Like for the ones who actually move the needle, the institutional investors, like when you look at them, right, they're looking at, what can I get for a 30-year treasury? 30-year treasury, get 4%, right?
Mm-hmm.
Or I can buy a couple apartments in cash, right, at a 4 cap, let's say. And, I'll diversify and I'll buy them in nice markets. But if inflation is the issue, okay, well, is that inflation going to increase my rents? Typically does. And so now I have the 4% alternative to a bond with the potential of growth through inflation. I think that's how they look at it. And I think they're the ones that move the needle. I think for us, we don't have the buying power that they do. But for the investors like us, I think there's much more risk if you're going to try to, finance a project that's stabilized or turnkey and bank on your growth from
organic
Yeah,
rent.
that I
Yeah.
think there's a risk there because you're buying negative cash flow right now. Like the cap rate it's below the interest rate,
Yeah.
you know?
Do you see interest rates normalizing here? Because obviously the Fed has all the control. Maybe they pause these rate hikes, and I think once they pause, they're probably not going to go back to it, or they shouldn't. And maybe they do another, quarter basis point, or 25 basis point increase. However, where do you kind of see interest rates normalizing once they normalize here in the next 6 to 12 months?
Yeah, that's a good question. I'm look, I'm trying to take the Fed's conversation or their plan at face value. I'm expecting I think as we get into 2024, I think that's when we start seeing interest rates coming down. I wouldn't be surprised if we see a pause this year for the rest of the year. There's people that see that differently, but that's kind of my expectation. I think 2024, we start seeing them come back down. Where do they land? That's an interesting conversation. Will we see like 0% again? I don't know.
Yeah.
I can make the argument. I've heard the argument on both sides. What we're planning for is interest rates not coming back down. What we're planning for is them staying and potentially going up, even though I don't think that's what's going to happen, is how I'm looking at it. So I
Yeah.
don't know, like on where do they land? I don't know yet. That's a good question. I don't know yet.
Yeah, that's kind of what we're doing with our deals right now from an underwriting standpoint. We're pricing in that we'll, be refinancing into perm debt sometime in 2025-ish at around a 6.5% interest rate, which means the Fed rate will be about 4.5.
Yeah, like I think that's high.
That's conservative.
I think that's high.
Yeah.
Honestly, in 2025, I don't think that's what we're
I agree.
refinancing in.
I agree.
But I agree with you. That's what we're planning for.
Yeah.
Yeah.
And so I'm like, you know what? Let's be conservative. If the deals pencil at this higher, interest rate, this higher cap rate, let's do it. Even though we got to show the investor a lower return profile because we're being conservative, I'm like, let's just do it. Because I don't want to overpromise and underdeliver.
Right.
I don't want to do that.
I agree.
I
agree.
I know
It's
it'll be a
bad
little bit
deal.
harder to bring the money in, but there's always a give or take, and I'd rather go that option.
If you under promise and over deliver, you will be here for a long time. If you oversell and don't deliver, your run will be short lived. That's just how it works.
That's so powerful, dude. As we kind of close out to the end of the show, I wanted to ask you, man, like, what are you most excited for as we kind of, get through the remainder of 23, 24? You did the skateboarding thing. You guys hit the gold with the brewery, and now you're buying a bunch of commercial real estate. You got your family, you got kids. But like, what gets you out of bed these days, man? What gets you excited?
Okay. There's a few things, and I want to make sure I stack them accordingly. I would say what gets me out of the bed first and foremost, I want my kids to see a good example of what a husband and a father look like. Like I want my girls to see, for who they end up, dating and eventually marrying. I want to give them a good, visual of that. And then for my son, I want my son to see what a man is and how a man is here for his wife. And so I would probably say that's first. But what I also want them to see is what it's like to work hard. And I want them to see what it's like to manage responsibility. And then why I would probably say second is what we're doing with the business. And then I would say third is everything I'm doing with the community. If you're looking at, some of these goals for our business, like we've been working on a Regulation A plus offering that I really want to have live this year. I am really, really, really like hot on that one. Some of our goals, we want to get to $1 billion of AUM.
I love that.
Our goal is to do it in the next 5.
Where are you guys at now?
From a gross standpoint, we're managing about 250. I want to do. Let me take a step back. Our goal over the next 5, I want to be managing $1 billion of real estate. So we're about a quarter of the way there. The second goal would be I want to be managing $1 billion of equity, like true AUM. I think we're a little bit further out on that one, but that's definitely a goal of ours. And then for the city, you kind of touched on it. I have 2 goals with the city. One, I want more young people to get involved that would never have thought to. I never thought I would do this. Like I'm hoping to be for my community the one that, hey, he did this? Okay, I could do this too. And we get more people involved. And then 2, like I want to make our community a place that our youth doesn't want to leave. Like that's one scenario that we face right now. We don't have a lot to offer for the 18 to 40-year-old. And my kids are going to get to that age. Like, I'd love for my kids to stay into this community and raise their kids here and, run that true like small town vibe. And so I'm hoping to make impact there as well.
Dude, I love that, man. I think everything you're doing is inspiring, and I know the people that come behind you or look up to you. I know you're doing a lot for them. So keep it up, man. And I appreciate you coming on the show, dude. I'm a huge fan, and I appreciate you coming on.
Thank you. I appreciate it.
Yeah, listeners, thanks for tuning in. We'll see you in the next one. Peace.